What's going on, everybody? My name's Jonah. I'm one of the banking bros here at the Money Multiplier. And today we're going to dive into the reality of how banks actually work. I know you think that you know how banks work, but this is what's actually going on behind the scenes. Not only will we talk about how they actually work, we're actually going to spend some time talking about how you can own a privatized bank. And you can own that if and only if you work your privatized bank just like the actual bank. So let's play along together. I'll ask you some questions. Here's what you should know from me. So here's my example. I don't know what you do for work. I know you're watching this YouTube video. You could do that for work, sure, but I don't know what you do. But here's what I do know. I know that every time that you get paid, you put your money into the bank. And guess what? I'm not picking on you. Most people do that. We put all the money into the bank every pay period, every Friday, whatever it might be, every other Friday, we put our money in the bank. So if I ask you this question, how much money does the bank have? Would you say a little or a lot? That's right, a lot, right? But if I ask you this clarifying question, well, how much of that money actually belongs to the bank? Would you say a little or a lot? A lot of people would say a little. Here's why. When you put your paycheck into the bank, that does not make it the bank's money. That's your money. You just gave it to them so they could hold it. Why do we do that? Now it's in 2022, it's because we want convenience. I really need a debit card. It's really hard to shop on Amazon without a debit card. Let's be honest, right? But they're not really giving us very much of anything else these days. But they are holding all the money. They're holding yours, mine, your family's, my family's, your friends, my friends. They hold everybody's money, right? Now, if we were to look at any bank you'd like to and punch them into Google on your phone, on your tablet, on the computer, and say, how much money did that bank make at the end of last year? What number is going to pop up on Google? Haven't tried it? Try it. That's right. It is a huge number. So the question I've got for you is, how did a regular everyday old bank that just holds everyone else's money make so much money for themselves every single year? I'll wait. I won't make you wait too long. The answer is loans, lending, financing. Now, again, let's be real. Banks do lots of things, of course, but their bread and butter, everyday activity is lending, financing, loans. Let's walk through one loan so you can see how lucrative this is. Let's say that I walk into the bank and I'm ready to purchase a brand new car. Let's say the car costs about $50,000. So I walk in and I say, banker, I really need a car loan. And they agree to approve me for the car loan. And what that means is they're going to now send $50,000 to the car dealership where the car is that I want to go drive. Question for you. Whose $50,000 did the bank just send over to the car dealership? Whose $50,000 was the bank holding? That's right, the consumers, the depositors. It certainly wasn't theirs. But before I leave the bank and go over to that car dealership and get my new car, the bank is going to make me sign a bunch of papers. Now, I won't walk you through all of them, but here's my summary of the papers that you sign. Thank you, bank, for the money. I'll give all the money back to you plus extra. Now, I did not harp on an interest rate. I know for a lot of consumers, interest rates and rates of return are the only thing they want to talk about. Here in this video, not so much. You know why I didn't harp on the interest rate? Because it wouldn't matter if the bank said 1% or 10% to pay that car back. The summary would remain true. You'd be required to give the bank all the money back plus extra. Notice I did not mention the length of time. Car notes sometimes are 3 years, 5 years, 7 years. I didn't mention the length of time because regardless of the length of time, the summary remains true. Thank you, bank, for the money. I have to give it all back to you plus extra. So for today's example, let's say I took that $50,000, I went and got the car. I'm happy, I'm driving my brand new car, right? Hopefully it's electric with gas prices these days, right? But I'm driving my car and every month now I've got a payment. So I pay and I pay and I pay. Some months early, I pay. Some months on time, I pay. Some months late, it doesn't matter. You finally pay the car off. Remember, length of time doesn't matter. Here's my question for you. Interest rate doesn't matter. Here's the question. Did you give the bank back $50,000 or did you give them back more than $50,000? That's right, more, right? So for our example, let's call it $60,000. The bank gave me 50, 3, 5, 7 years later, whatever interest rate, I gave the bank back 60. So here's my question for you. Who made money? That's right, the bank. How much did they make off you and one car? That's right, $10,000. But don't miss this. The bank also got the original $50,000 back. See, they didn't just make 10, they got the original 50 back in their pocket, which wasn't theirs to begin with. So, how much risk did the bank actually take? Not so much. Let's think this through. If you were too risky and weren't going to pay the bank back, the bank wasn't going to give you the money in the first place, right? The bank got all the principal back and then they made $10,000. Now, here's the question that I want you to harp on today. How many loans has your favorite bank done already today? This week, this month, this year? How's the bank doing with your money? You've got the opportunity to do the exact same thing inside of a properly designed whole life insurance policy through a mutual company that pays dividends, because these policies work more like banks than they actually do like insurance policies. See, when we design these policies, we also have a pool of cash that technically is someone else's, and we've got access to it. That's how the bank started their day. We can loan that money out to do anything that we want to, just like banks. Cars and houses and credit cards and vacations and student loans and fence in the backyard and anything else you can think of. But here's the important part, and a lot of people miss this. Banks would never loan money out and not make that person pay it back. You've always got to take that loan, use it if you're going to use it, or loan it to someone else and require a payment back. Not only just the principal, but always a little extra on top of that. The bank calls it interest. For us, inside of Infinite Whole Life policies, Infinite Banking policies, we call it paid up additions. But regardless, when you take loans, you always pay them back with paid up additions. If you don't, your bank doesn't make money. In fact, your bank might go out of business if you don't. Think about it. What conventional bank do you know that would give out a loan and not require payment back? And if they did that enough times, what would happen to that bank? Doesn't sound like very much of a bank to me, does it? Banks give out loans and require payments back. That's how the bank stays in business. That's how the bank has more money this year than they did last year. That's how the bank can use their money to get or purchase or pay off anything in the world they might want to. That is infinite banking. I'm Jonah Dew. I'm one of the banking bros here at the Money Multiplier. If you're ready to get started with your first or second or 100th infinite banking policy, give me a call. I'd be more than happy to walk you through it.